Hi, everybody, and thanks for joining our weekly podcast. I'm Robin Lewis, founder and CEO of The Robin Report, which, by the way, I like to say every week that it's much more than just a daily report. It really is a knowledge platform from which we communicate thought leadership on various strategic topics through the reports, yes, but also these podcasts, webinars, and hopefully live events as we move out of COVID. And along with our chief strategist, Shelley Kohan, who's also a professor at FIT and Syracuse University, we welcome you to our conversation today on the topic of Kohls under attack or being pursued for a marriage. Marriage is yeah. Anyway, Shelley, it's like Kohls is being attacked by a bunch of short-termer activist wolves. Notably among them is McKellum Advisors under the leadership of Chief Wolf, Jonathan Duskin. And actually, Jonathan's a good guy. But you know what his business is and what Kohl's business is, two different things, and they do attack. And on another front, I believe it was Axios who revealed that HBC, the Hudson Bay Company, is one of several bidders attempting to win the acquisition of Kohls. And when I heard that, Shelley, I immediately thought of Richard Baker, HBC's governor, CEO, and chairman. And of course, Richard Baker would want Kohls.
Of course.
But, yeah. But as you and I know, not for the logical, strategic reasons that most industry pundits and consultants would believe. In fact, I opened my article last week with the question, will HBC succeed in winning the bid for Kohls? And I answered, probably. But then I asked, should Kohls do all they can to repel such a deal? And I answered, absolutely. And then I asked why. Why? Because Richard Baker, real estate mogul extraordinaire, and he really is, but that is just what he is. So, you know, as he reviews the totality of Kohls, its problems and opportunities, he is assessing its potential, its problems and opportunities. He is assessing its potential new revenue streams and strategic and structural changes, including economies of scale, consolidating many of the supply chain and administrative functions that can be shared across the HBC enterprise. However, and this is the key point here, all roads in his brain ultimately lead to real estate. In other words, quote unquote, unlocking value as he described the spinoff of the digital and physical businesses of his current retail brands, the Saks and Hudson Bay properties, or unlocking, say, an opportunity such as launching stores in Canada. Also, what about a sale and leaseback model? You know, like a REIT. Remember, that model was what sucked the life out of Mervyn's way back in the day. All of such calculations are, consciously or not, driven by real estate. I mean, it's his DNA. Retail is not.
Yeah, that's right, Robin. I remember I was living in California during the whole Mervyn's, kind of decline, which was really sad to see. But it's interesting that most of Baker's buying and selling deals are really retail entities. And none of them were off the charts, even successful when he acquired them, nor were they very much approved when he then, switched ownership or sold them. So if you look at, for example, Lord & Taylor, when he got Lord & Taylor, Lord & Taylor was struggling when he picked them up and kind of limping along the way, as was Fortunoff, if you remember Fortunoffs. And both were still fairly irrelevant when he sold them. So he really didn't do much to kind of drive, the performance or create, better value for them, so to speak. Same for Kohls, the retailer in Germany. He paid $2.5 billion for that department store in Germany, and then he turned around and sold it for $3.5 billion. So he made a killing on that one. And then don't forget, as you recall, the whole Lord & Taylor sale to WeWork. So that, again, was another deal that he made. All of these deals at their core were real estate driven. So as his acquisition in Zellers, that Canadian chain stores, in 2008, he turned around and sold those to Target in 2011. And that deal made about $1.8 billion in profit.
Yeah, well put, Shelley. And as we podcasted a while ago, the spinoff of Saks and Saks.com, as well as the HBC stores and online entities, was not only counterintuitive to what all the other winning retailers have documented as they continue to perfect the omni-channel model, think Target, Walmart, Macy's, and others, that consumers spend 3 to 5 times as much when they have multi-channels to shop. It also strengthens the engagement with the consumer. Again, Shelley, it is all about real estate. And by the way, if Baker were to acquire Kohls, it would not surprise me one bit if that might be one of the first things he would do to Kohls. Again, all roads in his brain lead to real estate, which may not align with the long-term strategic vision that Michelle Goss and team have in mind, and certainly telling of where Baker's focus is. I mean, back during one of Women's Wear Daily's summits, he was being interviewed on stage, and when asked about how he finds the retail business, and I'm a paraphrase here because I don't have the exact quote, but he said, the retail business is really tough. Real estate is a lot easier. So, Shelley, what is the status of this auction process?
Well, first of all, Goldman Sachs is managing the process, and it's going to take a few months to come to some type of conclusion. As reported in WWD, a deal is likely to be in the high $60 to $70 per share range. Bidders are HBC, Sycamore, Leonard Green, and Partners, and of course, Starboard Value, Akia Group as well. And some of the numbers just regarding the health of where Kohls is today, and I'm actually going to compare 2021 to 2019 for obvious reasons. I'm not going to compare to 2020. That was a difficult year for ready-to-wear and department stores. But Kohls ended 2021 at almost 2019 levels. So they were down 1.3%. So the department store sector as a total was up 3.6%. But if you look at Nordstrom's, which was also down more significantly than 1.3%, and Macy's was also down about 3.4%. So when you compare Kohls to the two other kind of big department stores, Macy's and Nordstrom's, actually, though being down 1.3% was pretty good. But here's some interesting numbers. So the net profit for the year for Kohls was 4.8% of total revenue compared to 2019, which is 3.6%. So while the sales were slightly off, they are driving a much stronger profit. And gross margins, get this, Robin, gross margins climbed from 35.7 in 2019 to over 38% in 2021. So they're getting more margins out of the business too. And if you I compare Macy's and Kohls, they're kind of similar. They're heavily reliant on accessories and apparel business. And like I mentioned, Macy's was down about 3.4%. Macy's gross margins are actually going down a bit, 38.9 down to where they were over 40% in 2019. And Macy's, their net profits are still pretty strong, 5.8% coming out of 2021. But Macy's is heavily reliant on the apparel business, as is Kohls. And so when we look at that kind of apparel business, Macy's is actually significantly behind in apparel sales. They're actually losing share in women's apparel. It went from being over 21% of the business to now only 18% of the business. Kohl's, on the other hand, is actually gaining share in apparel and men's and women's accessories. And they're also increasing their national brand. So they went from 63% of their portfolio mix of national brands to now 66%. So yeah, when I look at the health of Kohl's relative to the department store sector and I compare it to other like businesses, I would say that the health is pretty strong. And regarding some of the real estate moves that a suitor might be looking at, some reports actually value Kohl's real estate at $8 billion, which is higher than the company's current market cap of around $7.8 billion. So bidding on Kohl's has actually pushed the stock price up.
Yeah. And Baker's looking at that real estate value, and he's probably got a lot of pieces of the puzzle he's putting together already. Anyway, and Shelley, I've written about Kohl's, as you know, and Michelle Goss, her strategic vision. And early on, when she started Kohl's, I had a conversation with her, and she is very smart. In fact, I called her in the article, I called her Daredevil in Chief. Her Procter and Gamble tenure, and as you know, Procter and Gamble is arguably one of the greatest marketers in the world.
Of course,
her tenure there obviously gave her a deep understanding of the consumer, and at some point she then moved on to Starbucks, where she created the drink that is now, a household word. Think the Frappuccino. That was her baby. Anyway, my point is that she understands young consumers, which Kohl's is shifting towards a younger core. They have Amazon shops in almost all of their, I think, close to 1,150 stores, maybe even more than that now. And they did the shop-in-shop deal with Sephora.
Fantastic.
Brilliant, yeah, which will become a $2 billion a year business for them. And they're seeking such deals. They also have smaller neighborhood stores in their future. Their private branding strategy is outstanding, and they have increased their activewear assortments by 40%. And they've also added Calvin Klein, Eddie Bauer, Tommy Hilfiger, and FLX to their mix. Again, seeking that younger core. And Shelley, not only does Kohl's have to go through the angst of considering all of these bidders, in the background, well, not really in the background, there is a very outspoken activist group, namely McCallum Advisory Group, led by Jonathan Duskin, who, as I mentioned, I once attacked in an article I wrote when he attacked Children's Place, which CEO Jane Elfers turned around spectacularly, I might add. Anyway, to make a long story short, Jonathan Duskin's in the business to make a lot of money quickly. In other words, I call these activists short-termers, leveraging debt to make short-term moves ostensibly to increase the value of stocks, along with inserting board members who are supportive of the activists' goals.
Yeah, I mean, Robin, so to that point, I did some research on McCallum Advisors and the performance of 3 specific retailers that they got involved with: Bed Bath & Beyond, Big Lots, and City Trends. So I'm sorry, but forget about unlocking value. It's more like value destruction when you look at the numbers. So I'll start with Bed Bath & Beyond. So when you look at the impact that McCallum had on Bed Bath & Beyond, they joined in 2019. And when you look at the revenue growth, it just went down, down, down. So down 7% in 2019, 2020, tough year for everyone, down 17%, although Home Store during the pandemic actually did well. And now they're down 12%. So what's interesting is, you just see this decline of revenue, and you also see a decline of the EBIT margins going from 0.4% down all the way down to negative 4.2%. So again, this whole, sale leaseback idea, it just doesn't, pan out long term. And then if you look at the, total share revenue, and you look at the 1 year, so you look at the S&P retail index. So the retail index over the last year was down 10%. When you look at Bed Bath & Beyond, they're down 26%. So I don't really see the unlocking value kind of increasing profitability anywhere in those numbers. When you look at Big Lots, so Big Lots, again, the strategy, they went into the strategy saying that they're going to pursue a sale leaseback. Again, same strategy. And when we look at those numbers again, as soon as, McKellen and his group started in Big Lots advising and the appointed directors on the board, again, we see that value going down. The TSR for Big Lots 1 year is down 44%, which again, compared to the retail sector down 10%, is just, we're just not seeing that unlocking value. So they actually did complete their, sale leaseback strategy in June of 2020, which gave a little bit of bump up into the EBIT numbers. And the EBIT numbers went from 3% to 6.4% in 2020. But then you look at 2021 and again, back down again. So just not seeing that revenue and that unlocking value. And then you look at City Trends, and this is really interesting. In City Trends, when you look at, again, when those directors, McKellen's directors went in May 2017, I think Duskin joined as the director there in 2017. And you look at that revenue, 2017, the company was up 8.6% in revenue. In 2018, down 1.9, 2019, down 1.6, 2020, down 0.2. So you see this revenue decline. And here's a shocking number. Their total stock return is down 61% compared to, again, the retail index, which is down 10%. So
unbelievable.
When I talk about this, that shareholder return number, so I'm going to read this quote to you because this is actually from one of the board, the people on the board for the City Trends came out and made this statement about Dusky and kind of his idea of unlocking value and his expertise in, turning around retail businesses. Here, and I quote, this was in a letter to the shareholders. Mr. Duskin does not bring retail operating experience to City Trends, and his track record contradicts his claim that he can drive meaningful, positive change. During his tenure, the board has found Mr. Duskin's short-term focus to be inhibitive and slowed the board's ability to have productive discussions regarding initiatives to drive long-term value for the company and our shareholders.
Oh boy. Yeah, there you go. I mean, those are three great examples, Shelley. And, talk about long-term strategic vision and short-term. Anyway, Shelley.
And let me just add one more thing, Robin. So in a shareholder letter, Duskin, this January 2022, in his letter, literally another letter, the Kohl shareholders said the exact same thing about the sale leaseback and how Kohls is not proactively doing anything to drive the business. So here we go again.
I know. And you talk about a little financial engineering, so to speak. Listen to this. McKellen bought 2.5 million Kohl's call options at a $40 strike price, okay? And so in the 2 weeks before Acacia's unsolicited expression of interest was publicly reported, McKellen then sold most of these in the following trading days, okay? Pocketing $27 million at the expense, of course, of fellow shareholders. By the way, McKellum, in terms of Jonathan Duskin, own a 5% share of the stock. Furthermore, they publicly stated that Kohls was worth at least $100 per share as it was actively trading options. I must say, Shelley, these guys do know how to make a quick buck. And I have to make,
that is true.
$27 million. Anyway, and I have to make a last point about McKellum's slate of nominees. 6 of the 10 have never served on a public company board. All of their nominees lack relevant public board exposure to large retail organizations. None have public company CEO experience. One nominee, Duskin himself, served as a director at 5 companies, and get this, that filed for bankruptcy either during or after their term. 2 nominees were senior executives at companies that filed for bankruptcy shortly after their departure. And one nominee was an audit committee member of a SPAC that acquired a fraudulent company with negligible revenue. Shelley, I'm going to close by offering a couple of quotes by my friend and colleague, Walter Loeb, who most people know well. He truly is a giant and a veteran retail analyst. He goes way back. But anyway, he was quoted last week in Women's Wear Daily. Always a straight shooter, by the way. Walter said, Kohls is going to blossom if you leave Michelle Goss alone. There you go. If a deal happens, it maybe could work, but only if they keep Michelle and the merchants in place. Though typically the new owners try to put their people in, and that was Walter's quote. And I, of course, totally agree. And Shelley, you got anything to add here before we sign off?
Well, I'm just going to add that, this whole takeover discussion, threats, bids, it's been going on for a long time now. And honestly, Robin, it's a real distraction to the business for Michelle, for the management team, the entire company. And as you and I talked about, Robin, the CEO plate right now is really full of all these crazy wild cards going on. So leave Michelle alone. Yes, Walter is spot on. Let her run the business.
Yeah.
The brands that have been added to Kohls have been terrific. The strategic partnerships have been great. Sephora is going to add a lot of value to Kohls. And I say let the U.S.'s largest department store run itself.
Yeah, totally agree.
For our listeners, you can find more of our podcasts on Spotify, Buzzsprout, and therobinreport.com. And look for us on YouTube, where we're uploading our podcasts as well. And follow us on social media, link in with us, and follow us on Twitter for the latest thoughts about the industry.
And I want to thank everybody again for joining us. And as I always say, if any of you have an idea for a topic that you would like Shelley and I to cover, please send me an email at robin@therobinreport.com. Thanks again.